So today on the Accounting for Our Community podcast, we are going to be speaking with Raffaele Ruberto, tax partner at SB Partners, on cash extraction strategies and estate planning for owner managed businesses. So before we jump in, I just want to give a little bio about Raffaele. So as mentioned, Raffaele is tax partner at SB Partners. He is result oriented and has the ability to translate complex tax rules into simple terms so everyone can understand. Along with his talented team in the tax department, Raffaele helps clients with their corporate reorganizations, estate and succession planning, postmortem planning, corporate and personal tax minimization strategies, and also dealing with the CRA, or Canada Revenue Agency. So welcome, Raffaele.
Thank you.
So, question. If I want to extract money from my corporation, what is the most tax efficient manner to do so?
So before answering that question, what I would do is start with the introduction that in Ontario, individuals are taxed if they're earning in excess of $220,000. They will be taxed at about 53 points on salaries. At about 47% on dividends that they take from the corporation, and then about 26% on capital gains. So as you can see, there's quite a bit of a difference. There's quite a big spread between salaries and capital gains of about 27%, and between dividends and capital gains at about 21%. So with that in mind, individuals looking to extract cash, obviously someone looking at it, they would like to extract it at the capital gains rates because it's taxed at the lowest, which is about 26 and 3/4. So if someone is looking into extracting cash, we have a strategy which is called surplus stripping. And what that involves is with a series of reorganizations, an individual can extract money instead of a dividend and be taxed at about let's say 48%. They can get taxed at about 26, almost 27%, and achieve savings of about 21%. So let's say on $1 million, the tax savings will be about $210,000.
Wow.
Yes.
Yep. Okay. So if I am a business owner and I wanted to extract cash from my corporation to, let's say, buy a cottage or something to that extent, what would be the most tax efficient manner to do so? So
we would recommend a surplus strip strategy. And what that does is individuals, because right now the individual who's the owner of the corporation, they will be looking into extracting the $1 million and what it is, it's after-tax return earnings. So taking into consideration a small business, they would have already got taxed on the return on this $1 million, and the only way to take it out without further planning would be to pay taxes at about 47%. So the taxes will be about $470,000. Versus by having a surplus strip strategy is that they can extract it at about 26% taxes, and they would pay about $267,000. So again, achieving about 21% savings. In order to implement the surplus strip, there's a series of reorganizations that need to be done, as well as a facilitating corporation will be required. But all in all, there's quite, again, on $1 million, tax savings of 21%, it's quite considerable. $210,000 could buy, for example, a lot of landscaping on that cottage.
Yes, absolutely. So you definitely want to speak with your accountant or tax professional in order to apply one of these types of methods. So are there any risks associated to doing the surplus strip?
Yeah, that's a question that we get all the time. I would say currently over the past 4 years, we have implemented in excess of 50 of these plans. And it's a question that clients ask all the time. Currently, there's no general rule that prevents these these plans from taking place. However, these plans are under the radar of the CRA and finance. Will there be some rules preventing these transactions? It's all to be seen, but to date, these are more than viable options that we currently offer to our clients.
Excellent. Now, my business is successful, and I want to start considering how I want to transfer that wealth to my children or my future children or family members. What is the best method to transfer my legacy to the next gen?
That's an excellent question. It's something as well. These are questions that we get from clients. They worked hard, they've built a very successful business, and they want to make sure that it gets in the right hands. There's not one question fits all, but in general, what will happen is the business owner usually gets to a decision point where the business either has to be sold to third parties, taken over by an employee, or by a family member. So in such situation where the business owner has decided that one of their family members is the right fit, then the next point is to transfer it because I find a business continuation is more important than tax savings. So once they get the right fit and make sure that the business can go to the next generation, then the next is to strategize how to do this transfer in a tax efficient manner. So usually what we recommend is implement what is called an estate freeze, where the owner would freeze the current value of the company and then allow the next generation to subscribe for shares for the company and then participate in the future growth, as well as having the voting controls. This is the general statement. There are some new rules where it's called the Bill C-208, which is currently in the makings, and this is it's going to be a big deal for business owners, because what it will allow people to do is do this do a transfer of business, but also be able to save up to $1 million per person. So let's say a business that is to be transferred and it's worth $1 million, the business owner can save about $920,000 in taxes and be able to transfer that business to the next generation on a very low tax rate. These are changes again that are currently in the making. CRA has indicated that there will be some policies that will come into play, but for now there are some alternatives to either have it on a taxable basis or have it at a considerably low tax base.
Okay.
The transfer, yes.
And so, as part of estate planning, when do you recommend a business, and especially like a family business, consider creating an estate plan?
So, usually what we recommend is at least preferentially it's 5 years prior to the transfer. If not, the very minimum, it's 2 years. And the reason why it's 2 years is that, again, in the Income Tax Act, there are specific rules that the business needs to have. What we do is we call looking underneath the shares. So it's not only a transfer of shares from one individual to the next, but we need to look at the assets that are held within that corporation. So what I mean by it is that we need 50% of the assets to be in an active business for a 24-month period, and then at the time of the transfer, 90% of those assets need to be in the corporation, need to be in an active business. So these are strategies that we call purification strategy. So and the time lapse is about 24 months, so 2 years. So I would say at the very minimum 2 years to discuss the plan with us.
Mm-hmm.
Yes.
And in your experience, what are the biggest challenges business owners have with creating an estate plan?
The biggest challenge is that business owners think that they will live forever, and then that they will be involved with the business for a very long time. However, the two certainties are death and taxes. So taking that into consideration, it's very hard because we understand that business owners work very hard. Their life goes into the businesses, but also but again, it's that continuation. They want to make sure that the business succeeds going to the next generation. So I would say the hardest part is when people come to the realization that it's time to move on.
Right.
Yes.
Right. Are there any other best practices or recommendations that you would like to share regarding estate planning and for owner-managed businesses?
An insight is to make sure first that everybody has a will in place, and that it gets properly reviewed either by a lawyer but as well as an accountant, because what business owners will like to make sure is that it could be the will is 10, 20, 30 years old, and the wishes that they had in mind many years ago might not be suitable to either current assets, current family dynamics. So it's always a good thing to have a will looked at, as well as making sure that it's a good check for business owners to look at their total net worth, so that the total net worth and the will together will work in the advantage of the business owner, and that the assets will go to the right beneficiaries.
Excellent. Well, thank you so much for
Thank
sharing
you.
your insights today, Raffaele. And if you have any questions about estate planning or extraction strategies, please reach out to Raffaele at SB Partners.
Thank you.